Good morning and welcome to this Wednesday, April 29th edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we had a pretty good day yesterday, at least at the open, but then we did see a sell-off throughout much of the day with the NASDAQ in particular getting hit harder than other areas. We've really seen a shift, and we're going to talk about that a little bit, but we've seen a shift the past couple of days away from stocks that were benefiting from the stay-at-home craze and social distancing, and money actually rotating back into more value-oriented stocks. Some of the stocks have been beaten up pretty badly throughout this move from the all-time high back in February. So I suspect that it's going to be a temporary shift, but it's hard to say how long it goes. Could go another couple days. But I got a couple charts that definitely want to show you in terms of that. Before I get into any of that, those of you who are new to Invested Central, I just want to point you to our homepage. If you're unfamiliar with Earnings Beats and maybe you're just checking us out for the first time, I think it would be a good idea maybe to subscribe to our free Earnings Beats Digest. It's a newsletter, comes out 3 times a week, Monday, Wednesday, Friday, completely free, no credit card. Just sign up, subscribe, and you'll get an idea of some of the things that we look at in terms of the market. So we've got, normally we're going to focus either on earnings, maybe upcoming earnings. A lot of times we use many of the indicators that we follow to predict what we might expect with earnings. I think we do a pretty good job. You can't, never going to hit 100% of the time. But I think more often than not, we have a pretty good sense based on the things we follow of what kind of earnings report's going to come out. So occasionally we'll do that. Actually today in this morning's, I can tell you I featured eBay, which was, they actually report after the bell tonight. And that company really has been soaring over the course of the last month, ever since that March 23rd low. Even though specialized consumer services, its industry group has not been very strong. We've seen a huge rally in eBay shares, and I suspect we're going to find out why when they report their earnings after the bell today. So anyway, if relative strength, earnings, accumulation distribution, that's been a new tool that we've added to our charts here over the past several weeks. That's been a really big benefit to all of us at Earnings Beats, just to try to see exactly what's going on underneath the surface of the market. We've had a lot of gap downs, but we've seen a lot of buying throughout the day. So where is that money going? And I think the accumulation distribution has helped us. So anyway, check this out. Make sure you subscribe. Again, it's free. That'll really give you a sense of the way we approach the market. Looking at yesterday's action, you can see the market did come back down. We finished in the red, but we started strong. We had futures up. Just, anytime you get the volatility index, I always look at the VIX above 20 minus and below 20. Below 20, I'm much more apt to trade it. I mean, even if it gets into the high teens, I start getting a little nervous. But, when we're below, say, the 17 level and it's falling, that's usually a pretty good time to be thinking about getting back into, holding longer term. If you're, I don't mean buy and hold. I'm talking about, if you're a swing trader, holding for maybe weeks instead of just a day or two. Because this has been a rough market for the last 6 weeks to just jump in and just hold, especially on the long side. I mean, it's been great for the last month, don't get me wrong, since that March 23rd low. But I don't think too many folks thought on March 23rd that we were going to go up just like we have. I didn't. I thought we would have a bounce, maybe go back, get a retest. I don't think we're going back down for a retest now, though, based on everything I'm seeing in the market. I mean, for the NASDAQ to come back as far as it has, that's been pretty impressive. So I think we're going to consolidate. I wouldn't be surprised to see 3-4% more to the downside, maybe test some key moving averages, some recent lows. But otherwise, I think this market is poised to go higher. I just don't see a move back down to the panicked lows that we saw on March 23rd. But the Dow down fractionally, S&P the same, NASDAQ was down 1.4%, 122 points. But yesterday and the day before, we've seen this flip in the way the market's been behaving, and mid caps being up 1%, small caps being up 2%. That's part of the flip You know, these are two areas that have been underperforming. They outperformed yesterday, and I'm going to show you a couple key charts I think will illustrate this a little bit better. As far as the sectors, when you look at the sectors across here, these are the sectors that had been lagging for the past 6 weeks when the market's been rallying. Now, all of a sudden, they're leading. Energy, industrials, materials, and financials. Those four, on a relative basis, have been lagging for the last month. And now they're, showing some leadership. I mean, you see materials actually breaking out above the 50, the 20s crossing above the 50. That's looking much better. PPO's positive. All these others, and these are the worst areas, financials, industrials, energy. Look at their PPOs, all poised to go positive. Energy trying to break out above its 50-day moving average, actually did that yesterday. Industrials doing the same. Financials right on the doorstep. So even the bad areas are starting to see money rotate into it. And I think that's overall a bullish sign, even though, we've been poised, or we've been, I would say even better word maybe is positioned in some of the other areas of the market that have been leading. I find this, the fact that the bull market is starting to pick up some of these lagging groups, I think that's a good sign. I think rolling over and seeing everything go down would be a much more bearish sign, especially if price support levels were failing to hold. But I actually like what's going on here. I really like to see the 10-year Treasury yield move higher. We'll get into that in just a minute. The other area, and this area hasn't been that bad. You can see on a relative basis, moving through the 50-day moving average earlier in April, pulling back, hitting the 20 and rising. So this has been a pretty good group. Staples, it hasn't been as good on a relative basis off of the low. It was actually doing really well on a relative basis on the way down. So it struggled a little bit on the way back up, but that's not completely surprising when you consider it's a defensive group, and usually when the market rallies, defensive areas tend to lag. So overall, the action yesterday, I actually thought it was not that bad. I mean, yeah, again, some of the areas that were leading lagged, but we saw the rest of the market, the weak areas, actually pick the market up, which I think is a good thing, at least from a longer-term market outlook. All right, let's go over and take a look at the 10-year Treasury yield. We did have a couple of economic reports out. We had the Q1 GDP initial reading came out, minus 4.8% versus 3.7, minus 3.7. So Q1 GDP, and I was actually looking at it, I thought it's not going to be that bad. It's not going to be minus 3.7% because really we didn't get hit until into March. So 2 of the quarters were still fine. And it was probably in the second week of March, things started to slow down. So I didn't think we would see a bad number, but it did come in worse than expected. So I was a little surprised at that. Minus 4.8% versus minus 3.7. We do have pending home sales coming out at 10 a.m. And this is, home construction reports. Anything dealing with home builders, home construction tend to be lagging reports. But the pending home sales number coming out will be March. So this will be one of the first numbers in the home construction area where we look at the impact of what's been going on with the virus. And the estimate for March pending home sales is minus 10%. So that'll give you an idea. Wall Street not expecting a very good report there. And again, that'll be out 10 a.m. The Fed is meeting. They're in their second day. They started meeting yesterday morning. And today at 2 o'clock, they will announce their latest policy statement. So keep an eye on that. Can't imagine they're going to say anything, but hey, we're here. We're ready to help. We're ready to do whatever we have to do. I think the market overall will like that. But the markets run a lot. So I wouldn't be disappointed if we got sideways consolidation. In fact, building a little bit of a base here, I think would be a good thing. So a little bit of sideways action. I wouldn't be shocked to see more weakness in some of the areas that have been flying. Especially, I'll show you a couple of earnings reports where we've seen some great action. When you get into the three you must see at the end, we've seen great action with earnings, really good earnings reports, and now we're seeing a sell-off after earnings. Buy on rumor, sell on the news. So that is something that is very real and things that, something we have to consider. Don't chase these earnings rallies, especially if the stock's already rallied a lot into earnings. A lot of times you'll be disappointed. Again, wait until we get into that 3 you must see, and you'll see what I'm talking about there. All right. Other top stories today. And first of all, you can see the update here on the 10-year Treasury yield. The big difference between Monday and Tuesday, I would say, is that Monday, when we saw a shift from the growth stocks to value stocks, we saw money coming into equities from bonds. So bonds were selling off and the yield went up. So that's why we have this hollow candle. Yesterday, it was the opposite. So the yields were falling, and so that means money's rotating into treasuries. So when money's rotating into treasuries and also into the areas that had been weak in the stock market, that, you're like, okay, well, where does that money come from? Well, the money came from the areas that have been outperforming. So if you've been trading a lot of the top stocks, and especially the chart list that we have, the strong accumulation distribution chart list, those stocks definitely underperformed yesterday versus the weak accumulation distribution stocks versus the bond market versus the overall S&P 500. It was just a weak day, and we'll take a look in talking technically here in just a couple minutes. We'll take a look at what happened there. All right, what other stories out? GE warned of a Q2 hit. Not surprising. We'll get into some of the earnings. They came up a little bit short in terms of their earnings per share. Google surging after topping revenue estimates. Boeing announced they've burned through $4.3 billion last quarter, $4.3 billion, and the stock's up in pre-market. XRT, which is a retail ETF, up 24% in April, which, unless we have a big drop next couple days, is going to be the best month ever, with companies like Wayfair and Etsy, ETSY, leading the way. The one thing that's left out of that headline is, of course, the XRT got crushed in March. So you got to take things in perspective. When you have a huge move to the downside, saying you've made 24% in 1 month in April, that seems really impressive until you realize you're still not where you were when you went into March. So again, keep it in context. And then just maybe 15, 20, maybe 25 minutes ago, positive data came out on Gilead's coronavirus treatment. Last time I looked, Gilead was halted in pre-market trading. So I'm not sure if they have opened back up for trading or not, but futures rose on that news. I think, again, some of the stocks that have benefited from this stay at home, if you start getting positive treatment news, some of those companies are going to, pull back on that news. So I wouldn't be surprised to see this shift to some of the more value-oriented stocks continue today. That wouldn't be a surprise at all to me. So let's move into talking technically. And I want to show you first the NASDAQ, the QQQ. This is the ETF that tracks the NASDAQ 100. Pulling back yesterday from the level where we pulled back is not surprising at all. We've had multiple levels to try to clear. And anytime you get into a big sell-off where you take out multiple support levels, that gives you multiple resistance levels to have to clear. And so you've got a lot of technicians, including me, who will say, hey, we got to get through this level, or we're not going to get through this level. I tend to leave it open. I look for key areas where we could reverse. For instance, on the way down, first thing I was looking for was 20-day moving average. We got up there, it looked like we were rolling over. I was like, okay, here comes our double test, that retest of that March 23rd low, but we didn't get it. Instead, we made a much more bullish move to the upside, getting through the 20-day, breaking out above prior highs. And so now you start a pattern, higher high, higher low, higher high, which hasn't ended yet. But we got through the 50-day moving average. We got through 3 Fibonacci levels, 38.2, 50%, and 61.8. All 3 of those we got through on the QQQ. And then what I think is really the last remaining major resistance level before we go shooting back to that February high is this reaction high. So we had our first major move lower. Look at the volume pickup at the end of February. Here was the reaction, that first reaction. So what I'm seeing maybe longer term is a move up, come down into an inverse left shoulder, neckline, back into a lower low for the inverse head, come all the way back up to test this neckline. And so any kind of a pullback And I mean, inverse left shoulder was down at about 198. I don't think we go down that far, but I wouldn't be shocked to see us go back down maybe to at least test the gap support, maybe even the 50-day moving average. So I'm going to say maybe 201, 202, 203 wouldn't shock me in the near term if we were to pull back. I mean, remember, we've gone up a lot, so we got to give the market a little bit of room to the downside. I wouldn't be panicked over a move down into the low 200s. Now, if we lose the moving averages, you see the VIX pick back up, go up into the 50s, yeah, we could have a completely different market environment. But to the downside, I'd be treating this still more of a bull market advance with buying on pullbacks than I would we're rolling over and going back down to March lows. That's my opinion. So I wanted to show you that. I also wanted to show you this IWF IWD chart. So this is the iShares Russell 1000 growth stocks versus the Russell 1000 value. So growth versus value. And you can see it was already starting out 2020 on a roll where we were breaking out above prior highs. We got into mid-February, we topped, and it looked like value was going to take over. And then throughout the entire decline in March, this has been one of those head scratchers, I guess. When you're thinking bear market, you don't think growth stocks are going to outperform value. Normally, it's the exact opposite. So when we were going down, one chart that really remained in the bull's corner was this one, where you've got money moving into growth stocks. You wouldn't expect there to be an appetite for risk when the market is getting killed. And that's what we saw in March by this ratio. So growth continued to outperform value. Now, we've had pullbacks. We saw the pullback in February. We've seen a couple since the March 23rd low, but then we had a big rally, and now we're in one of these pullbacks again. So, you know, when we're looking at these last couple days and you're wondering what the heck's going on, keep this chart in mind. You know, you can't just go up every day on this chart. There's going to be some rotation. There are going to be bounces, getting folks involved in some of these weaker stocks. I believe on a relative basis, this IWF, IWD is not done yet. Could we pull back further? Yeah, I actually think 1.48 is a level that we could gravitate toward. Maybe test that recent low. Also test the 50-day moving average. But if we get down there, I would expect at that point there are going to be some really nice trade setup available on many of these growth stocks that have been leading. So short term, a little bit dicey. Longer term or more intermediate term, I think that some of these stocks can be setting up really nicely. And again, when I go over the three charts you must see, they're going to be companies that reported really good numbers, looked great, and are pulling back in this current environment, which I think could be setting up for some great opportunities. All right, next up, let's look at that XRT chart. Okay, so here's the news headline I saw today. XRT up 24% in April, best month ever. So if you know nothing else about the market and you haven't been following things, you're like, wow, retail stocks are doing great. Well, again, take it in context. We were at 46 when we started April. You know, after 5 or 6 weeks to the downside, went from 46 to 30. Now we've gone back to 36 and change. So yes, the headlines are accurate. This is the best month, potentially the best month ever for the XRT. But keep things in perspective. You know, we had a massive decline from the February high down to that March 23rd low, 46 down to 26. So what is that, 45%, 45%, somewhere in that range in 4 weeks, 3 weeks, 3 to 4 weeks. I mean, yeah, okay, we're up 24%, but again, keep it in context. But you do have great companies out there that are performing extremely well. Wayfair has benefited. I mean, I think short term they could be in trouble just because they've run so much. And you've got, you know, a lot of these types of companies that are just taking a back seat to other areas of the market. So I think you're going to see potentially folks that have been riding this wave to the upside are going to take profits. Those that have been chasing recently, as the prices go down, they're going to panic out of their positions. And that's probably going to set up some nice opportunities. Wayfair on a move back down somewhere in the 90 to 100, maybe even slightly above 100 range, I think would be a great opportunity. Because they're not just going up for nothing. They're going to have a great report. Company has been, you know, accelerating. to the upside. Clearly, sales have picked up because of the stay-at-home orders and the social distancing. A lot of folks doing their shopping from home. Wayfair set up perfectly for that. So I like the company, but I wouldn't be jumping in after an extended run with this much room to the downside. I think the risk reward favors the shorts at this point, or reward to risk favors the shorts. Okay, I want to get into some of these earnings. Google came out with earnings. So let me, let's see, we'll go, there's the chart, but let's go ahead and set this up so you can see. I'm going to go through, I think before we even look at the charts, what I'll do is go through the actual, where they're trading and tell you what their numbers came in. Google beat their revenues, but they actually missed on their bottom line, 987 versus 1040. But you can see the stock up almost 8% in pre-market. So Google getting a nice pop to the upside. I wouldn't be surprised to see a sell-off after the open. Maybe you've got room up to 1,400. So you got a little bit of room, but I also think you got maybe 100 to 150 points to the downside. I'd be a little careful. If I was in Google in earnings, I'd take the money at the open personally. Starbucks beat 32 cents versus 31, but they did say their future earnings are going to be impacted by not having their cafes open. Market still kind of like in the report, up almost 1% pre-market. MDLZ. This is Mondelez International, stock down pretty much flat. AMD, Advanced Micro, kind of waiting to see what they were going to do. They actually reported earnings that were expected, 18 cents. So no beat, but no miss. The stock was down $3, I think, after hours yesterday. So it's come back quite a bit with futures rising. And now AMD down only 1% or so in pre-market. How about DXCM? There were some companies I talked about in our Monday webinar. We had our Q1 earnings webinar. If you're not a member, you can go into Earnings Beat, sign up. It's a fully refundable $7 30-day trial. And you can go back into our webinars archives and you can pull this up and take a look at it. Dexcom was one of the stocks I said I loved going into earnings. They were in the medical supplies area, which has not been a great area, but this stock has been on fire, as you can see on the chart down here. Look at it coming out with its earnings, up 8% with earnings this morning. So if you're thinking about holding stocks into earnings, you definitely should go back and check out that webinar. I think I went through 20 or 25 stocks that I really love going into their earnings reports this week. Dexcom was one that I mentioned. I think I may have mentioned them as an honorable mention. The only reason I didn't put them in my top group was because medical supplies has not been one of the best areas of the market. But the stock itself looked awesome heading into earnings, and they're showing why with their earnings. Now, doesn't look like it's going to break out on the gap up. So my guess is, again, you're probably going to see a sell-off. I would take that money and run on the opening bell. What else do we have here? How about MASI? This was one that I liked going into earnings. Massimo, stock up 3%, 219. That's another one that's gapping up. Looks like it's going to gap up underneath key resistance. That usually is a sign for me that it's probably gone too far. I would suspect that, either at the open or early in today's action, you're going to have an opportunity to get out and probably be able to enter it a lot cheaper. Let's go to a couple reports out this morning. Let's take a look at Boeing. So Boeing announced they had dropped or lost 4.3 billion. They burned through 4.3 billion in cash last quarter. And then they come out with their earnings, which actually beat estimates. I don't know if this qualifies. Well, a beat's a beat. But they lost $1.70 per share. The market was expecting them to lose $2.04 per share, though. And you can see the stock up almost 5% in pre-market. Now, Boeing has been in this downtrend. We're going to be back up around 137. I don't know. I really want to see stocks get above their 20-day at least before I would even begin to entertain the thought that they're in an uptrend. I mean, if the 20-day is going down and you're below it, especially with what the market's been doing, I would have a hard time being interested. I need to see, I'm more of a momentum trader. I need to see a break above the 20. I need to see that 20 start turning higher. I need to see successful tests off the 20, breaking to new highs, those types of things that we've seen on plenty of other stocks. So I think it's still early to get into Boeing. If you're somebody who says, hey, I'm not retiring for 20 years and I really want to get into a great company like Boeing, I can't really argue. I don't think Boeing is going to be out of business, but they are burning through a lot of cash, and I'm not sure all the pain is built into the price yet. But if you're okay holding a long time, I get it. How about Humana? This is another company in that healthcare provider space. I really liked Humana going into its earnings, up 2%, $7 today, $3.70. Humana came out, beat forecast, $5.40 versus $4.84. Beautiful reaction here. I think the stock, if it can get through this close, if it can close above, say, 382 or so, I think that would be bullish. We're currently at 370, so another one that's gapping up, but not clearing key resistance. So that, I believe, sets up maybe for early weakness. LH, another healthcare stock. This is at Laboratory Corp of America. Stock actually had been performing great. This could be one of those buy on rumor, sell on news. Stock down close to 2% today. They came in with great numbers, $2.37 versus $1.96, but the stock has gone from 110 to over 180. Well, close at 175 yesterday, all in the last 2 weeks, 2.5 weeks. So this has been a huge ride to the upside, getting close to key resistance. Watch the 20-day moving average to the downside. Coming up after the bell tonight, we got Microsoft, Facebook, Tesla, Vertex Pharmaceuticals, one of my favorite biotechs. ServiceNow, eBay, wrote about that one in the Earnings Beats Digest this morning. Again, sign up for that free newsletter right here. Go to earningsbeats.com, sign up for the free newsletter. The beautiful article in there today about eBay and how they look like they're poised to come out with a great number after the bell tonight. Align Technology, Teladoc. Talk about a company that has been on fire. Teladoc reports after the bell later tonight. So a lot of interesting earnings reports coming out, but the market has priced a lot of good things in for some of these stocks. So if you do get that rally at the open, don't be afraid to take some profits, see if you can get it back in a little bit cheaper. So speaking of that theme, let's take a look on the three you must see at three stocks, CDNS. All three of these companies came out with strong earnings, have been performing exceptionally well. Look at CDNS, the accumulation distribution. When prices were going down, usually you would see this going down. Instead, we went down on the initial move, and then this second move down, we saw CDNS moving higher. Professionals were accumulating. Individuals, retail traders were panicking out. But Wall Street was more than happy to take everyone's shares. And now look at what happened. Back to the upside. 52 to 82 in 6 weeks. I think the accumulation distribution indicator has been a really good one for us. And I think it will continue to be. I don't think that this push and this paradigm shift is over just because of a couple of days. I'd be looking at these companies on a pullback. Watch CDNS if it gets back to that 20-day moving average close to the recent low. Next up, how about TradeWeb, TW? TradeWeb Markets breaking out yesterday and then posted a pretty bearish candle. PPO looks great, probably just a little bit overbought, I would say. You've got the 20-day moving average down closer to 50, recent lows down around 50. I think if you get a pullback here on this stock, look at the accumulation distribution. Beautiful. So I think if you get a pullback here, back down close to that 50, 51 area, I would be very interested. So I'd be thinking about using any weakness here to jump in. TradeWeb just came out with great results recently, beating top and bottom line. Final one, and I mentioned this one recently, Edwards Life Sciences. I am watching this. When it gapped up at 235 and put in that big black candle, I said, watch to see if this thing can get back down to the 20-day and close to its recent lows. Now, it broke out at 200. I think worst case, maybe it goes down to 200. But I'd be looking at, if we get weakness down to the 20-day, 211 down to 200, I think you can build a position. Just my opinion. I mean, you have to take your own risks. But 211 down to 200, I think looks pretty good on the long side. I expect we're going to get another move back up to 235, 236 in time to challenge that. So I think EW looks good as the final 3 and 3. So I want to thank everybody for stopping by. Again, go over to earningsbeats.com. Make sure you sign up for our free Earnings Beats Digest if you're not already a member, or join us. Go back and look at that webinar we had on Friday. Join right here. You can go in, see all the things you get, sign up right here for $7, which is fully refundable. Everybody have a great day, and hopefully it'll be a good one for all of you. Happy trading.